Lizanne, let me start with you about those jobs numbers. They did surprise, I think, pretty much all of us. What do they tell us about where we are with the economy, and how did the markets react?
Well, certainly on the surface, looking at the headline payroll numbers, it shows an ongoing amount of resilience in the labor market that is quite surprising. You could pick a little at the numbers if you wanted to by looking under the surface. There continues to be a pretty wide gap between the establishment survey, which is a survey of companies, that's what generates the payroll number, and the household survey, which is a survey of just that, of households. That's where you get the unemployment rate from. And the household survey tends to be a bit more of the appropriate tell when you're at a possible inflection point in the economy, and that's been much weaker. And then the last thing I'd say is, yes, the wage number was better than expected in that it downticked a little bit, which is good news from the perspective of the Fed. But that may be a function of mix shift because so much of the job creation was in lower wage segments of the economy, which, of course, when you put more low wages in an average, you get a lower average. So I would say, under the surface, it was a little more mixed than the headline.
David, what did you take away from it? I mean, we did have a lot of jobs created. As Lizanne said, the wages didn't go up as fast as we thought they might do, but maybe that's not such good news.
Well, but there's no doubt that it was a strong jobs report. It surprised to the upside. We're always excited about the monthly jobs report on Friday at 8:29 a.m., but right afterward, it's just another data point, and no one single data point makes a trend. But the data as a whole would suggest the labor market remains very, very resilient, still creating more jobs than the natural growth of the labor force in the United States. And it's a full employment economy. I think that's the main message, that even with all of this Fed hiking so far, we're still at a full employment economy.
Well, let me follow up on that, David. Can the Fed get inflation under control with a full employment economy?
That's what's the big challenge here. And we can debate all day long about the need for watching more data. The jobs market, the inflation report next week will be, I'm sure, scrutinized. But I think we're at the stage, given the turmoil in the bond market this week, the past couple of weeks, where the Fed should be thinking about what it can do to help calm and reduce risks for the bond market and bond investors, because the labor market so far seems to be taking care of itself just fine.
So Lizanne, what about that? To what extent do you expect the Fed to take into account the turmoil in the bond market? Because certainly we have had that this week.
Well, I think you're starting to hear, you had Mary Daly making comments yesterday about the spike in the 10-year, to some degree, doing some of the Fed's job for it. The one unique aspect, or maybe rub in this cycle as it relates to what should be happening with the kind of surge in yields in conjunction with what the Fed has done on the short end, is the transmission mechanism through the economy, certainly the consumer side, the business side. And I don't want to say the economy is much less interest sensitive, but when you look at what many companies have done in terms of terming out debt, you look at things like the mortgage market and the fact that there's so much more of a bias toward the fixed rate side of things versus the variable rate side of things, like was the case in '06 when the Fed was raising. I don't think it eliminates the impact, but when we all talk about, and quote Milton Friedman, with the long and variable lags, the lag component of it may have been added to by virtue of some of those offsets. But this, the spike to 4.8, it's the speed, I think, that we have to have some concern about in terms of, something breaking, as is often said.
David, pick up on what Lizanne Sonders was talking about there, and that is the question of maybe the economy is a little less sensitive to rate hikes. And if that's true, because of some of the reasons she suggests, the term of some of the debt, corporate and personal debt, if that's true, does that mean the Fed has to hike more, have to go further to get the attention of the economy?
Lizanne's totally right that the lags are uncertain, and the economy has been resilient in part because it's a service-driven economy, but also it's only recently that we've gotten clearly to positive real interest rates. For a long time, inflation was still above where the Fed had the overnight rate. And if the economy hasn't slowed down enough, and of course, inflation has come down more, but there's no guarantees that it might not reaccelerate. And if you're a 10-year bond investor, you want to be comfortable that inflation is not going to reaccelerate over a longer period of time. owing to labor market conditions, supply conditions, and deficit conditions. And I think this is the thing. When the Fed goes into their meeting at the end of the month, makes a decision November 1st, I think they need to ask themselves what action helps to prevent the 10-year Treasury yield from going over 5%, because I think that would do more damage to the economy and perhaps cause a hard landing. So I think the Fed needs to act in a way that calms the bond market and prevents 10-year yields from going higher. And usually what makes bond investors bullish is when the Fed is hawkish.
So David, based on what you've seen so far, you think actually the way to calm the bond market actually would be to raise rates?
It's a tough call, but with the turmoil we've seen in the bond market and the uncertainty that's going to be going on with the budgeting process, certainly through and into November, because the continuing resolution only being 45 days till November 17th, I think it's important that the bond market know that the Fed's got its back, while DC is not really taking too much concern with these deficits.
Lizanne, same question to you. Is the best way for the Fed to calm the bond market, if that were their priority, is it to raise rates at this point or not?
Well, either raise rates or at least maintain somewhat hawkish rhetoric and continue to emphasize the for longer part of higher for longer, which Powell has certainly been trying to do. The other issue here is that, we know the risks that come from such a speedy move up in yields and the ripple effect through the economy, the concerns that, as David mentioned, are around the deficit and financing our debt, given some supply-demand imbalance. But there's also been so much lending done in the shadow banking system in private markets. So that's one of those sort of opaque areas where you wonder whether something could break in an area where it's hard for any of us as market watchers or even the Fed to have a sense of where those potential cracks are.